This video walks you through Chapter 10's overview, focusing on standard cost and variance analysis. What you're first looking at is typical given information in order to solve for variance analysis. We're told here that budgeted production is 25,000 motors. Our standard machine hours, our standard input to produce one motor is 2 machine hours. Therefore, our budgeted machine hours is 25,000 motors times 2 machine hours per motor, or 50,000 machine hours. We're told actual production is 20,000 motors, and this is important. Our standard machine hours allowed for actual production is taking our actual motors of 20,000 times the standard input per motor of 2 machine hours, and we get 40,000 machine hours. This 40,000 machine hours is what we call standard quantity. Standard quantity, as well as you can see here, our actual machine hours, is not how many hours does it take per unit. It's how much input does it take at standard to produce 20 motors versus what do we actually take in input to produce the 20 motors. So at standard it says we should only use 40,000 machine hours, standard quantity or total quantity. Actually, we used 42,000 machine hours. So this is typically where students make a mistake. They think it's asking for, in the formulas SQ, AQ, the machine hours per motor, but it's asking for the machine hours per motor times actual production. Then we're given budgeted variable and budgeted fixed. When you add it up, you get total budgeted overhead of 375. Actual variable overhead and fixed overhead. Add it up, you get total actual overhead of 379. Now before we go on, I just want to give you a quick review of a couple things. Raw materials is one of our first inventory accounts in manufacturing firms. It's made up of direct materials and indirect materials. Once we start creating or assembling our products, that raw material flows into work in process. Work in process is made of direct materials, direct labor, and overhead. Now, overhead is going to be the applied overhead or the estimated overhead using the predetermined overhead rate, POHR, predetermined overhead rate. And when you think about what is overhead, it's made of your indirect materials, your indirect labor, and all plant and factory costs, excluding direct materials and direct labor. Then once we are finished building something, it moves into finished goods on the store shelves, and then once we do sell it, it moves into cost of goods sold. Now, one of the things students need to understand is over and underapplied overhead. So when you look at the manufacturing overhead account, the debit side is always for actual cost. The right or credit side is for the applied overhead. So when you're asking yourself, am I over or underapplied? Always look at the credit side, the applied side, and ask yourself, is my applied greater than actual? Then I'm over applied. If my applied is less than my actual, I'm under applied. Now, what does that mean? Well, if applied is greater than actual, we're going to have a credit balance here. Remember, my applied overhead is part of my work in process. So if it's too large, it means my work in process cost that flows to my finished goods is too high, which means when it flows to cost of goods sold is too high. So at year end, when I compare actual to applied and I realize I've got a credit balance, I want to get rid of it once I've sold my products. So to get rid of a credit balance, I'm going to debit manufacturing overhead, and I'm going to credit cost of goods sold. The debit to overhead gets rid of this credit balance, and my credit to cost of goods sold reduces, because it's an expense. When you credit expenses, it reduces it. So when you're over applied, your cost of goods sold is too high. But when you do your year-end journal entry, you're going to reduce it. When you're under applied, your cost of goods sold is too low. So we're going to have here, when I'm under applied, what is that going to mean? It means I'm going to have a debit balance. To get rid of a debit balance, when I'm under applied, I'm going to credit manufacturing overhead and debit cost of goods sold. When you debit cost of goods sold, it increases it, so it's no longer too small. So I just want to give you that mini review. Okay, what is this saying to us here? In a normal cost system, the debit still is actual overhead, but the credit takes actual hours, meaning actual quantity, times your predetermined overhead rate. In a standard cost system, the debit's still actual cost, but we're going to take standard hours allowed, which means it's SQ times the predetermined overhead rate. So just wanted to show you where the AQ and the SQ come into play. Then the last thing is showing you why when you have variances, and again we have direct material total variances, direct labor, and we can have overhead. We want to break them into their respective quantity variances and their respective price variances. Why do we want to do that? Well, let's focus on direct materials. You can see after doing some calculations that your total direct material variance might be favorable. But when you go deeper and separate it into quantity variance and price variance, you might find that your price variance is actually unfavorable. And the person who controls that is your purchasing manager. Versus you might have a favorable quantity variance, meaning how you're using the amount of material that you're using in your material variance is within range, and that is responsibility of your plant manager. So we want to break it down, because total variance, when you take and add the quantity and the price variance, could cancel each other, and you might have a total variance that says it's favorable. But when you break it into its quantity and price variance, one might be unfavorable, one may be favorable. The other thing to remember too is that, again, you want to be looking at what is controllable cost versus what's uncontrollable cost. For example, in direct labor, your price variance may be unfavorable because minimum wages have changed. Well, that is not a controllable cost to the plant manager. They have to absorb it, but more than likely we're going to have to change our standards now to incorporate the minimum wages have increased. So those are the things that variances will help you with. It's not enough just to say, do I have an unfavorable or favorable variance? And not large favorable variances are good. Because if you have too large of a favorable variance, what that's saying is your actual cost is less than your standard. And if it's too large, that says your actual cost is, or your standards are too high, and you're maybe pricing your product too high, and therefore not doing a good job in competition. So again, too large of a favorable variance or too large of an unfavorable variance both need to be investigated equally as hard.